So the last unit of this class really has to do with exploring issues that lead to market failure. And market failure is when the market fails to achieve the socially optimal outcome. In competition, we talked a lot about the benefits of the market in terms of achieving a good outcome for society. That the profit incentive meant that businesses were trying to produce exactly what consumers wanted to consume, and that we were producing at minimum efficient scale. That's great, but not all markets are perfectly competitive. In fact, many of our markets are not, and we have issues of market failure. So that's what we're going to start to explore in more detail today. First, if we think about why is a perfectly competitive market socially optimal, or why is the market equilibrium socially optimal, we can see on our graph of supply and demand that the market equilibrium maximizes total surplus. And this is also the Pareto efficient point, because we've exhausted all mutually beneficial trades. So to think about this supply and demand graph from the perspective of society, we can conceptualize demand as the marginal benefit of the product, right? Demand represents the consumer's willingness to pay for a product, which we know is derived from the amount of utility that they get from consuming the product, right? We went from the utility function to the demand curve and saw that demand represents the value to the consumer of the product, of the good, okay? So demand is the marginal benefit, the benefit of each unit of this product, okay? Supply represents the marginal cost curve. Remember, when we derived the individual firm's supply curve, it was the marginal cost curve above the minimum average variable cost point. And so our supply curve represents the cost of producing the product. The demand curve represents the benefit to the consumer of having the product. So from society's perspective, we only want to produce so long as the benefit of the product is higher than the cost, right? So we don't want to spend our scarce resources producing something that's not worth it, right? So we only want to produce as long as the value of the final product is higher than the cost of making that product, right? And from society's perspective, that's a good use of resources. We do not want to produce over here where the value of the product is smaller than the cost of producing, right? So this is like a loss of surplus here. Whereas this is a gain of surplus. See, the benefit is higher than the cost, and the highest amount of surplus we can have occurs at the market equilibrium. All right, so hopefully we understand a little bit more about why we are talking about the market equilibrium as socially optimal, and then that will help you understand why that might not be the case in certain situations when we have market failure. So we've already been talking about one source of market failure, the last two topics, which is that we're not producing at the competitive market equilibrium. Instead, we're producing at the at either a monopoly point or or a Cournot oligopoly point, right? So, so one, right, this is the competitive equilibrium. It is socially optimal. One reason why we might not be at the socially optimal point, why the market might not lead us to the socially optimal point is, for example, if we're producing at the monopoly point, which of course would have a lower quantity, right, and a higher price. So market power leads to market failure because when firms have market power, they restrict the quantity they sell in order to increase their prices, and that leads to fewer mutually beneficial trades, which of course results in less surplus and a failure to achieve the socially optimal outcome. In this section, we're going to be talking about a couple other types of market failure. So we're going to be talking about what happens when we have a cost or benefit that is external to the market, what we call externalities. And then we're also going to be talking about the situation where the good is non-excludable. Which really refers to the fact that property rights are incomplete. And as you'll see in this section, property rights are quite important to ensuring that markets can achieve the socially optimal outcome. So let's just say incomplete property rights here. And then the last one is actually the next section that we'll cover, which is incomplete information. In our model of competition, we've made several assumptions. We've made assumptions about the size of the firms. We have many firms, many consumers. No one has market power. We've assumed that there are no external costs and benefits. We've assumed that everyone has perfect information, right? And that there's no issues with property rights. So these situations will lead to market failure. And then, as we will see, in some cases, then it may be necessary for the government to intervene into markets in order to correct for that market failure.